Well, folks, I hope you got your popcorn ready because the movie's getting to the good part now at this point in time. Red Dead Redemption out there. Here today, the stock crash did resume. We have a lot of stocks to talk about in today's video. Holy smokers, this ain't no joke. There's a lot of stocks to get into, a lot of important things going on in the market. Obviously, my perspectives on all of this, opportunities in the market, busy, action-packed video. I appreciate y'all being here as always. Thank you for being subscribed. Thank you for smashing that thumbs up button. And let's just get straight into this, guys. So, clearly, Red Dead Redemption, pull up a heat map of the S&P 500 today, and it's going to tell you what was going on in the market. It was definitely a brutal day. It was red across the board out there. It's very few and far between you could find stocks green today. Now, when I see a heat map like this, I automatically think, geez, it had to have been a horrible day for me in the market. That's just naturally where my mind goes. And I checked out the public account today. I was down like $11,000 today. I will freaking take that. I can tell you that much. Thank you, okay? Thank you. When I see Red Dead Redemption like that and down 11K, I'm like, okay. I was expecting like a 50K type downward day here today. 11K, and I'm like, whew, yeah, I'll take it, man. Now, the NASDAQ has fallen around 9% since we entered the month of August, right? So basically, it's been a pretty vicious past, let's just call it about 2 months now at this point in time in the market, right? Now, if you look at something like SQQQ, right, it's up about 25% since the beginning of August. Now, what was I preaching video in and video out? Video in and video out in the month of June and July. And a few people, might have heard that, and a lot of people just chose not to listen. Hedging. I mentioned hedging 1,000 times. Hey, it might be an interesting time to learn how to hedge. Hey, it might be an interesting time to look into hedging strategies. Oh, here's some interesting hedging strategies, and I preach this video in and video out throughout June and throughout July. And, a lot of people now are starting to realize, oh man, how many times I say a little hedging goes a long way. If you've been watching my videos for a long time, you know how many times I mentioned that. A little hedging done properly goes a long way, right? And I think some folks are starting to realize, oh man, I am not hedged at all if this market gets any rougher, right? And keep in mind, 8-9% move down the NASDAQ in a couple months, it's definitely a hit, right? But it's not something crazy. When we talk about big NASDAQ drops, we're talking 20-30% and above type drops, right? That's what we're talking about. So yeah, this is something going on. Now, big tech here today got smacked. Very interesting things. And you got to ask yourself, why did certain stocks move so huge? Amazon's the obvious one, right? The whole FTC thing. I'm going to probably give a detailed, thought process on that whole situation eventually here, okay? But you got to ask yourself, why was Shopify down nearly just as much as Amazon here today? Why was Oracle down huge, Apple and Google? I'll tell you exactly why. The reason Shopify went down huge today, and doesn't make any sense, was basically in sympathy because of the Amazon move, right? But I can tell you, Amazon needs Shopify more than any other time in history now at this point in time. The FTC's after them. And basically, Amazon's going to need to show that they have real competition in the marketplace and that competition and innovation is not dead and there's other companies that are giving them a run for their money. Well, guess what? There aren't many companies in the world that can give Amazon a run for their money on the e-commerce side. One of the only companies you can even think of that's even a remote kind of competitive threat to Shopify, right? Or to Amazon is Shopify. And so if you're thinking about who needs to kind of continue to build their business and become a lot bigger of a competitive threat, it's a Canadian company like Shopify, because that will show there's innovation going on in the marketplace. That will show there's a lot of competition in the place from other players, okay? So that was actually a bad move. The whole FTC thing is the best thing that could ever happen for a company like Shopify, in my personal opinion, okay? Oracle, we'll talk about Oracle a little later on in this video, but man, that stock got hammered again today. Down over 3 percentage points on Oracle. Apple had a big move down here today. That smells of two things, right? One is, does anybody really believe all this hype we're hearing about iPhone 15 sales are super strong? I don't know, man. Based upon what I'm seeing in the stock price, it seems like investors aren't buying the whole, iPhone 15 selling like crazy. And also, the other thing is, you see the FTC make the move on Amazon that they made here. I can tell you, there's no bigger company that you could make an argument that is maybe anti-competition than Apple. Just to be quite honest, if you're very educated on all the big tech companies, you'll realize that Apple really controls everything. And because of their dominant position in smartphones, the cell phones that are in every American's pocket, right? Because of that dominant position, they hold all the power, and whatever they say goes. So if you think Amazon has any sort of anti-competition, monopolistic type of presence in the marketplace, I can just tell you, it pales in comparison to good old Apple. So in my opinion, that's a big reason why that stock was down here today. That Apple was actually the worst stock in the entire Dow 30 here today. The worst stock. Isn't that interesting, right? And you say, why was Google McDougal one of the worst big tech stocks here today? The reason being is Google's going through their own government fights now at this point in time. And these are going to be overhangs on these stocks for quite some time. I don't think the Amazon overhang's as big as a Google overhang will be, but both these are going to have overhangs for quite some time in regards to this. It's, as a Meta shareholder for years, we went through this with Meta. Meta had an government overhang for years that we had to deal with, okay? Look at PayPal. Holy smokes. PayPal was actually green today. You got to be flipping my flapjacks. What in the world's going on, okay? Etsy, I noticed this stock was down today. This is another one of those stocks that I think, if anything, this is great news for them in regards to this Amazon news. Etsy's, let's be honest, Etsy's no competitive threat to Amazon, but the fact is they are an e-commerce player. They're a pretty famous e-commerce player in the United States of America, and they need to kind of be shown as like they're some sort of competitive threat to Amazon, okay? Now, guys, we got problems. We got big, big problems. And some of these super famous companies that are seen as some of the most stable, safe business models out there, these stocks are dropping like rocks just day after day after day. Bath and Body Works, down over 4% here today. I mean, this stock's just getting hammered. It's now down over 31% year to date. What is that telling you? I'll tell you exactly what that's telling you. It's telling you that consumer recession's coming in 2024. Bottom line, that's what that's telling you here today. There's no doubt about it. It's either the market's wrong or the stock, or I don't know, man. It's either the market's wrong or it's not. I don't know. I'm just going to say probably the market's right in consumer recession, maybe in the first half at some point of 2024. That's what it's looking like, right? Look at Estee Lauder, down over 4% here today. 47% down year to date. The stock's been cut in half this year. You gotta be flipping my flapjacks. This is ridiculous. Estee Lauder is one of the best companies in the world. And the fact that this stock can't find a bottom anywhere. I mean, that's the thing with these stocks. You look at Bath and Body Works. You look at Estee Lauder. I mean, these stocks aren't even showing a sign of a bottom. That's the scariest part in all this. Is they're dropping like growth stocks were dropping last year. Go back and pay attention to what happened to NVIDIA last year. Look at what happened to AMD last year. Look what happened to Meta last year. Look what happened to Tesla last year. Look what happened to Shopify last year. Look what happened to Netflix last year. Those stocks never showed a sign of bottoming anytime. They were just dropped and dropped and dropped until finally they bottomed out around mid to late October and some into early November. And then things started to come back to life. And the same exact phenomenon is going on with all these famous consumer-related companies that you look at, and usually these are the most stable stocks and business models you could ever be in. And yet they're being traded like they're penny stocks, man. Penny stocks. What is going on? What is this, a planet? Estee Lauder being traded like it's a planet out here. It's incredible. But that's the market we're working through right now, folks, okay? Check this out. Estee Lauder is now close to a 5-year low, folks. Close to a 5-year low on this stock. Matter of fact, in the past 5 years, the stock has now found 4%. It lost all its gains in the past 5 years. That's how vicious the stock has been. It's incredible, man. Absolutely incredible. But guess what? This is the same exact phenomenon we saw with growth stocks. Many of those growth stocks, you could look at them on a 5-year basis, and basically in September, October of last year, they had all lost their 5-year gains. They're all trading at where they were years ago, years previous, 5 years ago, 7 years ago, things like that. Like that's how bad things really got, right? Look at RH. RH is showing no signs of a bottom either. That stock was down another 3% here today, down about 25% just in the past month. It's down about 30% or so just before earnings. I want to see this with something with $100 something in front of it. Once this hits $100 and something, you'll likely see me buy this stock in the public account. I'm not in a rush to buy RH, I can tell you that. Not after the horrible decision they made to basically buy back their shares with over $1 billion. If they would have not made that move, I might be buying RH right now. But with how bad of a decision that was to weaken the balance sheet like that, no, I'm in no rush to buy RH. Go down to $100 something and then we can talk, okay? Target just hit a new low. I mean, another one of these super famous consumer companies, and it doesn't matter what the dividend yield is. It's now almost 4% on target. Doesn't matter the PE ratio, the forward PE ratio. Doesn't matter how stable the business model is. It's just down right now, showing no signs of a bottom. And target down another 2.5% to a new low here today, right? Now, at first, I didn't know why Target was down. It was just, Target's down every day. So, like, sometimes these stocks, I'm like, they just go down every day. Like, who cares? Like, what's the big deal? And then I was working, and all of a sudden, I, had CNBC on in the background, and then all of a sudden, they breaking news in regards to Target. And I said, what's going on here? Okay, here's what's going on. Look at this. Target's closing 9 stores in 4 states due to organized retail crime. Oh, guess what states they are? Can you guess? Oh, yeah. The states and the cities in which these stores are closing, I'm sure a lot of people aren't surprised, just to be honest. Some stores closing in Seattle area, stores closing in Portland, stores closing in San Francisco and Oakland area, Los Angeles, Houston, New York City. I don't think that comes as a surprise at all. I bet you if anybody's educated and I asked them, where do you think Target's going to close some stores? I bet you they would have said these cities and in these states. Just bottom line, okay, in regards to that. So it's a huge problem that's going on. 9 stores closing, it's not like it's some huge material move for Target's business model. This isn't something that's going to, oh my gosh, their revenue's going to fall off a cliff now that they close these 9 stores. But you know what's the craziest part of this is, folks? Okay? Well, I'll get to the craziest part in just a moment. But here's what Target says in their statement. Quote, we cannot continue operating these stores because theft and organized retail crime are threatening the safety of our team and guests and contributing to unsustainable business performance. Here's the deal, folks, okay? The theft must be so bad at these stores that Target is like, we're losing money running these stores. We're going to have to close them. Because I can tell you, if these stores were still bringing in even a couple $1 million of profit, which wouldn't be that much for profit for a Target store because Target stores are usually massive, even if they were bringing a couple $1 million, I bet you Target would keep them open. These stores, the theft must be so insane that they're like, we're losing money operating these stores. It's actually a financial drag to our business, which is crazy. Because I can guarantee you those stores still got a ton of paying customers. It's not like every single person that walks in is stealing something. But that just goes to show you the moment in time we're in, right? So, this is an interesting situation. Very, very interesting situation. And let's hope that's the worst of it, and let's hope it gets better from here. But man, it's not the type of stuff you want to hear. It's not the type of stuff you want to hear. That's what I'll put it like that, right? Speaking about not the type of stuff you want to hear, Oracle stock just continues to plummet. Now, I'm pretty much done my research, or like 98% done my research on Oracle. I will say this. If this baby keeps dropping, there's a high probability I'll be a buyer of this stock in October through December, which I can tell you there's not a lot of big tech stocks I really like right now, either because they're already an overexposed position for me, meaning that it's too large of a position, or there's a situation where, there's just not a good deal. But this is one of the very few that I can find that actually is an interesting stock. The balance sheet's trash at Oracle. That's the one downside. But I'm willing to take that risk on a smaller position size likely, especially if this baby goes under 100. If it goes under 100, it's almost guaranteed that I start to buy Oracle. If the stock went up a bunch from here, I'll leave it alone. But the risk reward to me says if this baby goes under 100 and it can stay under 100 for those months, I'll likely build a decent sized position. This is going to be no Meta. This is going to be no Tesla. I can tell you that much. Just, maybe like a 50K type position. No, look at these super famous companies. They fall and they fall and they fall, right? Whirlpool down again today. Walgreens down again. Nike down again, right? Dutch Bros is not a super famous company. This is just kind of on there, right? More of a newer public company. But they were down again today. Cheesecake is trying to just hold on to anything. Wynn was trying to hold on to anything. And you're just going to ask yourself, like, what is going on, man? Like, these are some of the, most well-run companies traditionally over the past decades. Whirlpool, Walgreens, Nike, Cheesecake Factory, Wynn. Like, come on. And yet these stocks just, they can't find a bottom anywhere in sight, right? No, the Walgreens might be the craziest one. This one, the dividend yield is so high, you can't even count it now at this point in time. Holy smokes, this is ridiculous. Stock was down again today, 42% year-to-date for a Walgreens, right? This Amazon situation is great for them. The biggest worry with Walgreens longer term, in my opinion, is Amazon getting more into the pharmacy game and being able to send products to your home in a secure manner and deliver them straight to your home at a price that's cheaper and undercuts Walgreens. And so the fact that the FTC's after Amazon right now, it's going to be Amazon's going to have to show some sort of weakness in e-commerce over this next few years, and they're not going to be able to be nearly as aggressive as they'd want to be with the government after them like this. That's just the bottom line. So basically, the government is slowing down Amazon. That's the best way I can put it when it comes to kind of the e-commerce side now at this point in time, right? Bros. So Bros, like I mentioned, continues to fall. I mean, I think this one hit a new all-time low today. If it didn't hit an all-time low today, it's very freaking close, but I believe it hit an all-time low today. With Bros, I want it cheaper. I do want Bros. Okay, that sounds bad. That doesn't sound good at all, okay? I want Dutch Bros stock, okay? I want Dutch Bros stock, but here's the deal. I don't want it yet. Based upon this year's numbers, it's trading at about 138 forward PE, based upon this year's numbers. Based upon 2024 numbers, trading at about an 82 forward PE, and based upon 2025 numbers, we're talking about a 60. So here's the deal. I'm usually going to value like a year out. So if 2024 we were trading at, let's call it the 40 to 50 range right now, which would put the stock around, let's call it anywhere from $12 to like $15 a share, I'm a buyer Dutch Bros at that price. You got me. I'll start building a position. But for right now, 80 plus times 2024's expected numbers, not quite there. So if this baby goes under 20, then, I'd say the odds of me starting to buy goes up. If it goes under 15, I would say there's a high probability I'm going to build out a nice sized Dutch position, because I do really like Dutch Bros. I do like the business model. I do like the company for the next many years, but, the valuation matters, and I've been just kind of patiently waiting on this one. There's a few stocks I have to patiently wait on sometimes, and if they run away from me, it's fine. There's so many opportunities in the stock market, especially right now. I'm not scared. Like, if Dutch Bros runs away from me, it is what it is. Like, there's so many freaking buying opportunities right now. It's not, the time you have to worry about a stock running away from you is time periods when it seems like all of the stocks are hitting all-time highs, and it's just like, where do I put my money? And you kind of get in that FOMO cycle of like, all these stocks are running away from me. We're not in that time, folks. We're not in that time. We get some of the greatest companies in the world that are not tech stocks trading at 5-year, 10-year, 15-year, 20-year lows right now. It's a once-in-a-generation type buying opportunity for this next many months for many of those companies, right? So right now, I can choose. I can be picky right now because there's so many freaking opportunities. It's ridiculous. Check this out. Biden's out there with the UAW workers, right? Now, I've been on YouTube since 2016, and I've probably been asked since 2016 about the GM Ford, the automakers, right? Oh, they trade so cheap. Why aren't you buying those? I've had those questions for 100 years, right? Why not hedge your Tesla bet by a little bit by buying some GM or some Toyota or some Ford? My answer to that is these companies have so many issues that are so massive. Why would I? Here's the deal. Ford and GM already are going to have to fight for their lives because they have two of the biggest transitions going on that we've ever seen in the automobile industry, both happening simultaneously over this next several years. One is they got to transition their businesses all to electric vehicles from internal combustion engines. That's like the biggest change that's happened in auto since the Henry Ford days, okay? Crazy. On top of that, over this next several years, they're going to have to basically transition their business models all from humans driving the vehicles to the cars driving themselves over this next 5 to 10 years. Those are two of the craziest transitions you have to deal with. And these companies have to deal with them at the same exact time. Now, meanwhile, we got interest rates that have spiked up massively, right? Which makes it way harder to buy anything on a loan. Oh boy. On top of that, they're talking about trying to do 40% pay increases to the workforce. Come on, man. How are you even going to survive? If they're talking about 40% pay raises, and you're talking about this is not going to be a good consumer environment for buying autos for a bit of time here, because even if, let's say, interest rates crash down, right? Well, that means you're likely in a recession, which isn't good for autos. We look back at how many autos were sold prior to the Great Financial Crisis versus during the Great Financial Crisis, night and day difference. If you have banks tighten, that hurts your business even more. Then you've got two of the biggest transitions we've seen in the history of autos, electrification, and the cars need to start driving themselves. Oh, come on, man. It's too much. It's too much. The big question for these guys is, can they survive the next 5 to 10 years? That's the biggest question. Can they survive? Not can they thrive. Can they survive the next 5 to 10 years? And then you've got freaking Elon Musk and Tesla with his foot on their throat right now, who's just showing no signs of relenting and doesn't care about margins right now and says, I don't care. We're about growth. We're about volume. We're about numbers. And if we got to drop price 25 times during the course of a year, we'll drop price 26 times. That's tough. That's tough, man. And so bottom line is the automakers have been a value trap for 10 plus years, and they remain a value trap, unfortunately, for those stocks. Now, woo-wee, you want to talk about some big comments that will scare some people? Neil Kashkari. Boy, did he scare some people today. Fed's Neil Kashkari sees a 40% chance of, quote, meaningfully higher interest rates. When you say meaningfully higher, folks, that's not a little bit. That's a lot, okay? Minneapolis Fed President Neil Kashkari, who's probably one of the most famous names in the Fed outside of Jerome Powell, thinks there's nearly a 50-50 chance that interest rates will need to move significantly higher to bring down inflation. That's frightening, folks. That is absolutely frightening. Because you know what that means? That means he could be seeing a scenario, a 50-50 scenario, we can call it, or a 40-60 scenario, where we're talking about Fed funds rate of 8%, if not higher than 8%. Because once again, if you're talking about meaningfully higher, that's not a quarter point. That's not a half point. You're talking about several percentage points if you're talking about meaningfully higher, significantly higher. That's scary. Because do you know what that does to auto rates? Do you know what that does to the banking system? Do you know what that does to every, type of debt out there? Come on, man. That's a whole different ball game you're playing with there. Dealing with 5% Fed funds rate or 5.5%, that's one thing. Dealing with 7 or 8%, that's when you just start to break a lot of stuff. And I mean a lot of stuff, okay? Here's the deal. Mortgage rates continue to climb astronomically high. New home sales tumbled in August. Rising mortgage rates are just one reason. Sales of newly built homes slumped more than expected in August. This just came out today. It's latest sign of pressure on this bright spot in the housing market as mortgage rates rise. Oh, just wait to see the winter numbers, folks. It's going to be ugly times, ugly out there this winter time for sales numbers. I mean, when you're talking about mortgage rates, the places they are right now, this is not good, man. This is not good. This is a complete disaster. Now, look at this. Look at this headline out of Insider. You may hate high interest rates and home prices, but many baby boomers have reasons to celebrate, right? And let's think about it. Baby boomers usually own their own homes. They got that $550 mortgage payment for another 2 more years. They're on year 29 and year 30 of their mortgage. And their house is now worth $650,000. They got $500,000 in the bank that's now earning them 5%. They're feeling pretty dang good, right? The millennials get screwed again in this situation because the millennials are the ones trying to buy homes right now. And, millennials got screwed, obviously, starting their careers either right before the Great Financial Crisis, during the Great Financial Crisis, or like right after the Great Financial Crisis. So had to enter in very poor jobs. And baby boomers are sitting pretty in regards to this whole situation. Baby boomers have had it pretty good because they got to avoid WW2, because that was really their parents' generation had to deal with that, right? They got to avoid the 70s inflation, really. That was really their parents had to deal with that because many of the baby boomers were either little kids, like elementary school type age, or they were like teenagers in the 70s. So they got to enter the workforce in the 80s, and the 80s and the 90s were boom times, and the 2000s were boom times up until the Great Financial Crisis of obviously 2007, 2008. So yeah, man, that's a situation. So shout out to the baby boomers. All 25 of you guys watching this video right now, you guys are looking good, man. You guys are looking good. That's all I can say about that. Millennials, hey man, you were built for tough times. Okay, you were built for tough times. Now, millennials, okay, holy smokers, okay, this ain't no jokers. By the way, Gen Z's got it the best. Gen Z's got it the best. Because think about this. Gen Z, you can get a freaking job at like Chick-fil-A making like $17 an hour. And nowadays, everybody's so soft, they let you smoke a fat fatty before you go in there because, I don't want to offend them or something. Speaking about, the fatties, look at this news. Avant brands stink, causing mental health issues with residents. The smell coming from Avant brands' Jack Jackson production facility is basically causing neighbors to get very upset. Residents in the Vernon neighborhood have to wear masks because of the obnoxious smell coming from Avant Brands' Jack Jackson production facility in the community council heard this week. Oh my gosh, okay. What a situation. I'd never heard of this before, right? This person says, they're more worried, talking about Avant Brands, they're more worried about shareholders than their fellow neighbors. What? Oh my gosh, the 60,000 square foot facility for the product, I should have X'd that out there, basically, they've been producing, and it's been licensed since 2021. Residents in the area have been fighting for years for the company to do something about the odor. Johnson, who's the person in the neighborhood, says the company was given a warning by the city of Vernon last year, and it got better for a while. However, the smell is back and stronger than ever. It can be very annoying when you have to put up with the smell of skunk day in and day out. Oh man, I think this line right here just cracks me up. However, the smell is back and is stronger than ever. You ever want to like turn on somebody that likes to enjoy that product? Tell them that line right there. They're going to say the gas is strong and it's strong like Donkey Kong. Okay, they're just going to turn them on. It's like saying to somebody that loves to eat ribs, oh man, it's such a smoky barbecue smell. It's so annoying. And the person that loves ribs is like, I want some of these ribs. Oh man, it's something else. But anyways, that's the story going on. And in regards to Avant, it doesn't matter how strong the smell is, the stock never goes up. It never goes down either. I mean, the year to date is a 3% move for this one. So, hey, maybe they're producing some good product, and let's make some profits, Norton, okay? Maybe some profits? That would be nice. FinTech continues to get hammered. Square finally had a good day yesterday. Finally was green, and then right back to red. Down to $44 a share for Square. It's just brutal. Hood down under $10 again. SoFi, people are wondering, is SoFi going back to $5 or $6? I thought we were done with that. You know, that's what they're saying. Woo! I'll say this, okay, about these fintech stocks. Because you asked me, when do these stocks bottom? When do these stocks finally bottom out? I'll tell you exactly when these stocks bottom out. These stocks will bottom in the fourth quarter. These stocks will bottom in the fourth quarter, in my opinion. They will start to strengthen as 2024 goes along, and that's regardless of recession, no recession. It really doesn't matter. These stocks are already in their stage where they're pricing in kind of worst case scenarios and pricing in everything bad. And so now I'm not heavily invested into any of these fintechs really outside of obviously PayPal, but I believe all these stocks are in a bottoming out phase. They'll all bottom over the next several months, and then 2024 will be a good year for them and beyond, because regardless of situation, like these have priced in worst case scenarios. So that's my opinion on the fintech sector in general. We'll see how things play out, right? Obviously, based upon the things I'm hedged against, it was a good day for me. Polaris, Apple, Toll, Chipotle, all down here today. SDAO was up big here today, right? So definitely kind of liking how I'm hedged in the market. I still have another hedge to do in October at some point for 2024, but definitely like how I'm positioned as far as my hedges go. Look at this. Starbucks, usually seen as one of the most quality companies out there. This one, look at the 5-day on this baby. I mean, it's just brutal. Just down and down and down. Down 4% plus in the past 5 days. It just can't catch a break, which just goes to show you people want no parts of anything consumer related, folks. If this is a business selling to consumers, people don't want it. You can't talk to them about buying it. They want no piece of it. And it's what we're going on right now. And it's not going to go on forever, but it's certainly going on right now, right? Costco numbers just came out after the bell. Now, these Costco numbers definitely show some weakness, folks, okay? Comp sales were only up 0.2% in the United States. If you make adjustments, then it was up 3.1%, right? Which is kind of adjusting it to the way you want it to adjust. So you're going to take out gasoline prices, foreign exchange, stuff like that, right? So up 3.1% in the U.S. What? Like, folks, the number is still, like, not good. Like, for instance, in this same quarter last year, Costco's comp store sales were 15% plus. 15% plus. So we definitely are already seeing cracks in the consumer in quite a substantial way when you look at these Costco numbers. E-commerce was down for the company. Down for the company, okay? So these are definitely, and remember, like this was supposed to be the time where people were going to say like, oh, e-commerce is going to start getting healthier and healthier because, the 2021, you had all those crazy comps that 2022 had to deal with. We don't have those crazy comps now. 2022 was already the slowdown in the fourth quarter. And the fact that these numbers are still negative is definitely a little worrisome. Now, for Costco overall, the company's a freaking beast, okay? Total revenue for the company came in at almost $79 billion versus $72 billion in the same quarter last year. Operating income came in at almost $2.8 billion versus about $2.5 billion in the same quarter last year. Net income attributable to Costco shareholders was about $2.1 billion versus $1.8 billion in the same quarter last year. And then EPS came in at $4.87 versus $4.21 in the same quarter last year. So overall, Costco numbers very good. The balance sheet in general, cash and cash equivalents, is up to $13.7 billion. Short-term investments up to $1.5 billion. That's impressive. I mean, just impressive. Total equity is up to $25 billion from $20 billion in the same quarter last year. So Costco remains a beast. Stock's not getting hit very hard after hours, 1.5%. You'd say, why don't you own Costco? Here's why. The problem with Costco is it just trades rich, folks. We're talking about 38 times this year's numbers. We're talking about, 35 times next year's numbers. We're talking about, 32 times the following year's numbers. Like for Costco, I don't feel like there's a huge level of growth for Costco ahead. That does not mean Costco's best days are behind them or they have no growth. I just don't view it as like, Costco, they need so many more stores. I don't really view it like that, folks. I think they have more room for more stores in the United States. I think they have more room for more stores, certainly outside the United States. But in terms of their huge growth days, I don't really view it as that. And so if this is a $400 stock or a $300 stock, I'm probably buying the dip. But, $552, I'm not quite there with these sorts of valuations on this sort of company, okay? Now, what am I actually doing? So I'm buying dividend stocks like it's my freaking job right now. I was out there buying again today. I think this is like a once-in-a-generation opportunity we have over this next many months for these sorts of dividend companies, these consumer famous companies. I mean, you look out there, folks, these stocks are at 5-year lows, 7-year lows, 10-year lows, 15-year lows, 20-year lows, 25-year lows. It's not going to stay like that forever. I can tell you that. And so maybe we stay like this for a few more months, but this is not the way it's going to be long term. And, anytime you're expecting these deals to stay around forever, people get real picky. And they made that mistake last year, right? People are looking at me buying Meta stock for $88 a share and be like, you're crazy. At $120, you're crazy. Like, what? No, you're crazy for not buying it at that price. I was buying Tesla at the beginning of this year for $100-something, like $103, $103, something like that. I'm crazy. I think you're crazy. Palantir last year was $5, $6, $7. How are you not buying Palantir? Like, what are we talking about here? And you just go through the stocks. Shopify was at $25 last year. Netflix fell to, what was it? Netflix. I think it fell to $100-something if I recall last year. How are you not buying Netflix? So the crazy ones to me are the ones that see stocks at 5, 10, 15, 20-year lows and choose not to buy those stocks. And it's a lot of them. It's not like it's one or two companies. If one or two companies, you can say, I might pass on these companies. But when it's a lot, when it's like dozens and dozens and dozens of these great companies and you choose to pass, it's a poor decision. It's a poor financial decision, and you'll see it. You'll see it. You might have to wait 12 months, 18 months, 24 months, 36 months to really realize how bad of a decision it was to not be buying during that time period. But people will see. They will see over time that, man, that was a poor decision. And I hope these deals remain for the next 3 to 9 months. I would love these dividend stocks, these consumer-related stocks to continue to just get hammered or at least stay in these ranges where it's at for at least the next several months so I can just continue to kind of build out these positions, folks. But you've got to work with urgency in this market. You've got to work with urgency. Don't expect these stocks to stay down here for all of eternity, okay? Hope they go down more over the next few months, but don't make your investment decisions based upon, they're going to go down more, okay? Don't expect Win to go down to $50. Can it? Sure. That'd be great. I would love that, but don't plan on that happening, folks. If anything, plan on Win being $150, okay? That's kind of the way I think about these sorts of things, okay? I got 2 workshops for you guys. Make sure you take advantage of those. One, they're both pinned comment down there. One's investing foundations. This is if you're in your first 3 years of investing. Day 1 is why you invest in individual stocks, what to look for when researching a company. Day 3 is portfolio management and managing cash. Day 4 is growth, value, and dividend stocks and assessing those. Day 5 is how I know when to buy and sell stocks. That's pinned comment down there. And the other pinned comment will be how I find 10x stocks. That's about a 30-minute video that goes into, like it's a free workshop that goes into how I find these sorts of opportunities in the market. So appreciate everybody joining me as always. Thanks so much, folks. Make sure you take advantage of those free workshops that are pinned comment down there. Much love and have a great day.